The broadcast is now starting. All attendees are in listen-only mode.
بسم الله الرحمن الرحيم والصلاة والسلام على أشرف المرسلين وبعد. Good afternoon, ladies and gentlemen, and thank you for attending this afternoon's webinar. I hope the information I'll provide here will be very helpful and useful to you. The title of my presentation is The Instability of Our Financial System and the Coming Mega Financial Crisis, and I'll tell you why I believe it's a mega financial crisis. First of all, the basis of this presentation is based on a book that I published about a year ago, the research of which I did over a 6-year period, researching financial crisis and trying to find Islamic financial solutions to these crises. And of course, it's received praise from both inside and outside the Islamic finance industry. Here's a quick overview of what I'll be discussing today. First of all, what I want to ask, and hopefully you might have the question or the answer to this question, is when did the last crisis begin? I ask this question a lot because a lot of people have a different idea of when the crisis began. So first of all, let me pose this question and see who has the answer. Now, most people would say the crisis began here, September 2008, which is when Lehman Brothers collapsed. That is not correct. The true beginning of the crisis began much earlier than this, and I would say the true crisis began at least a year earlier, in February 2007, as you can see here. Freddie Mac, if you don't know who Freddie Mac is a quasi-government agency who was buying up a lot of the mortgage loans from the U.S. housing market. Because they were buying up the mortgages, the Wall Street bankers were eager to sell to them as fast as they can produce them. Freddie Mac, however, started to notice issues with the lower quality mortgages, which we later knew or became to know as subprime. They noticed that the quality was not as good as they would hope, so they decided to tighten the standards. Tightening the standards started to cause a ripple effect through the financial system. And in April 2007, 2 months after Freddie Mac tightened its lending requirements, one of the largest such lenders filed bankruptcy because they're already being hurt by this. In May 2007, Bernanke, the central banker at the time of the U.S., came out and said publicly that the subprime issues will not hurt the U.S. economy. This is how clueless he was. In June 2007, Wall Street started to feel the pinch. This is when 2 big hedge funds owned by Bear Stearns faced shutdown because they were betting in the subprime space. And issues in this started to cause problems for them, and 2 funds pretty much went bankrupt. In August 2007, another subprime lender starts to file bankruptcy. Now, according to the BBC, November 2007, the U.S. housing market was in a full-blown meltdown. This is still almost a year, roughly 11 months before Lehman Brothers collapsed. So now the U.S. housing market is in a clear crisis mode. What does Bernanke say in February 2008? He came out and he publicly said that the U.S. will avoid a recession. So the subprime was not only a non-issue for the U.S., but the U.S. will not enter a recession as a result of it. However, Bernanke was so misinformed that it turned out, this is according to the BBC, that in December 2007, according to the National Bureau of Economic Research, which is the official government statistician, said that the U.S. was already in recession 3 months before Bernanke came out with the statement. So Bernanke did not even know that the U.S. was already in recession. March 2008, this is when JP Morgan was forced to buy Bear Stearns. Bear Stearns, of course, collapsed, and the U.S. government brokered a deal that JP Morgan would buy it. Still, Wall Street is feeling the crisis now, but us as a global economy, we're not feeling the pinch yet. Not until, of course, Lehman, which was in September 2008. So the bottom line here was that if the leading banks and the largest, the leading central banks and the largest global banks did not see the crisis coming, how do you expect them to see the next one coming, much less be able to stop it? So why do we keep having financial crisis? Well, if you're familiar with an economic cycle, you'll notice that we have a growth period, we have a peak, we have a slowdown, and we have a recession. Between each one is roughly 4 to 7 years. This is normal economic cycle as we learned in economics. However, what I believe is that our economic cycle looks more like this. We're seeing it increase to the extreme on both sides over the years or over each time. So let's take a look at some of the past financial crises that we have. We can go back as far as we want, but let's start at least with the 1973, which is the first oil shock as a result of the OPEC oil embargo. It was later followed by the second oil shock, 1980, and then 1987, of course, we all remember Black Monday, which is the global stock market crash that actually began in Hong Kong and not in New York, as we might remember. Then we had the Mexican peso crisis, or it's also known as the tequila crisis. 1994 is still recognized among bond traders in the world as the worst year for the bond market, not 2008. This was a severe crisis where the U.S. government had to bail out the Mexican government. We all remember the dot-com bubble in 2001. And then, of course, we had the global financial crisis. As you can see, roughly 7 years between each major crisis. There are a bunch of smaller crises in between, but this is not accurate. We cannot say that every 7 years is a major crisis because we can't forget about 1997, which was the Asian financial crisis. This was a severe crisis for the entire Asian region, and it actually affected other parts of the world. So what about 2015 and 2016? I say that a crisis has already begun, similar to how in 2007 the crisis of the subprime began. I say that a crisis is beginning now, and I'll show you why. So what's the bottom line here? The financial system is built on a boom and bust cycle, and financial crises are frequent, and they're part of the system's design. The central bankers fixed the unstable financial system that caused the last crisis. Let's take a look. First of all, the U.S. government, after the financial crisis in 2008, decided to put together a commission to study the causes and propose solutions. So what this commission came up with is they came up with 4 problems that caused the financial crisis, and they proposed solutions on how to fix it. The first one is easy credit by subprime borrowers. The second one was there are too big to fail banks. Banks that became too big that allowing one to fail would cause ripple effects to the financial system, therefore you cannot allow it to fail. There was simply too much debt. Too much debt was not good for an economy. They recommended that too much debt caused it, therefore debt must be lowered. Complex derivatives, and I'll get into this into some detail. Complex derivatives cause instability in the financial system and therefore need better regulation and better control. And of course, anyone can download this report. It's available on the Commission's website. Let's take a look at these problems one by one to see what has happened since then. Easy credit and subprime borrowers. First of all, according to Bloomberg, it says junk bond issuance surges to 26 billion, and it's at the later stages of a boom. So Bloomberg is saying that it's at the latter stages of a boom and should be ending anytime soon. This is in November 2015. CNN Money came out and said it's a warning, half of oil junk bonds could default. Wall Street Journal said surge in subprime auto lending draws attention. So we had subprime mortgage lending, now it's subprime auto lending. But wait, National Mortgage News says subprime makes a comeback despite Frank Dodd. Frank Dodd was a law implemented to help stop this subprime mortgage lending. Well, according to this, it hasn't stopped, it's actually come back. And Bloomberg also says that the shale industry, which is the shale oil industry, could be swallowed by its own debt. It's weighed down so heavily by debt that any problem in the shale industry could make the debt pile collapse. So that's on the subprime side. Let's take a look at one example, which is the auto lending. As you can see, auto lending went down here during the financial crisis, but has since shot up to even higher levels and reaching new records. The securitization of auto loans is at a record level by historical standards, and the default rates are at a record level right now and increasing. What about banks' poor loans? Well, as you remember from the 2008 crisis here, banks in Greece, Spain, Italy, and Portugal started to experience a lot of high or non-performing loans. We heard a lot about Greece, we heard a lot about the bailouts they received, but we forgot about these 3 countries, Spain, Italy, and Portugal. These numbers, of course, are from their central banks. The non-performing loans of these countries in these banks have shot up to record levels as well. We don't hear about it, but these financial institutions in these countries are still going through a lot of non-performing loans that are only increasing over the years. They're not getting better. We're just not hearing about it. What about the recovery in U.S. housing? Well, this is a report, or this is a chart actually from the Federal Reserve. They show the one-family houses sold in the U.S. One family means a single-family house sold, new, not used. And as you can see here, this is the recovery. So yes, new family homes are being sold in the U.S. and they've recovered by 20% from the lows, but it's nowhere near to where it used to be. It's still at 1980s level. The housing market in the U.S. has not recovered, and it's far from it. What role did the rating agencies play in promoting this fraud in the debt markets? Well, let's take a look here. This is Moody's issuing its rating on Bear Stearns in December 2007. This was 3 months before Bear Stearns was about to collapse. They gave it an A2 rating. In March 2008, Moody's rated Lehman A1 with a stable outlook. This was, of course, 5 months before Lehman Brothers went bankrupt. And of course, AIG was rated AA3. Even though they gave it a negative outlook, AA3 is still a pretty high rating. This was 1 month before AIG needed a bailout. The bottom line here is easy lending today has become even bigger than it was before the crisis. In 2007, it was subprime. Today it's junk bonds and emerging countries' debt. What about number two, too big to fail banks? As you can see from this chart here prepared by CNN Money, 6 banks in the U.S. control 2/3 of the entire assets in the U.S. banking system. The remaining 7,000 banks approximately have 33% of the assets. So as you can see, the concentration of assets in the U.S. is really among 6 banks. 6 banks control the entire industry. So this is too big to fail post-crisis. They're even bigger today than they were in the past. Well, what about the bailouts? Who got the bailouts and who benefited? We all know about the TARP program. The TARP program was the Troubled Asset Relief Program. The Troubled Asset Relief Program was a $700 billion bailout program designed by the U.S. government to help those affected by the fallout from the mortgage business. And of course, as soon as it was passed, the objectives of it changed to helping out the mortgage companies and the homeowners to immediately being used to recapitalize banks, insurance companies, and auto companies, which had nothing to do with the subprime mortgage industry. Well, what about the homeowners? How did they benefit? The homeowners year to date have received roughly $4 billion from a new program called HEMP. But that's not all. The Federal Reserve Bank went on to offer emergency liquidity and credit lines to central banks around the world that needed to tap into it to address any liquidity concerns they had as a result of this. So at the height of the program, there was roughly $29 trillion in liquidity funding lines used by foreign international, primarily central banks, from the Federal Reserve Emergency Credit Line. Roughly $8 trillion of this went to the ECB alone, which is the European Central Bank. So as you can see, the homeowner and the mortgage companies did not get bailed out. Everybody else did. What else are these too big to fail banks known for? Well, since the crisis, we hear things that the too big to fail banks have been involved in. Primarily, misleading investors in the subprime debt, money laundering. They had a LIBOR scandal, a Forex scandal, and a gold manipulation scandal. These are just to name a few. There are much more. According to Forbes magazine, the too big to fail banks have paid between them $251 billion in fines as a cost of what they call it regulatory revenge, meaning this is what they had to pay for lying, stealing, and misleading investors. Bank of America alone has paid $120 billion in fines, the highest among any other banks. But as you can see from the other banks on the list here, they all were fined as well, and they were doing the same thing. The bottom line is that the largest banks are even bigger today, holding governments at ransom, believing that they will not be let fail. This ultimately results in banks being indifferent to the well-being of their customers or their money. They continue to engage in risky activities, as we shall see in the coming slides. This is one of the most important charts that I'll show you today. This is from the Federal Reserve. It's measuring the entire debt in the U.S. economy. This is government debt, private debt, all debt instruments. And it's comparing it to the growth in GDP. Debt, of course, is the red line. GDP is the blue line. As you can see here, since 1970, debt has had to grow at a faster rate than GDP in order to stimulate or get GDP growth. And this rate has had to increase at an increasing rate in order to get incremental growth in GDP. So growth in the economy is dependent on growth in debt. If debt growth slows down, as you can see here, we have global financial crisis. If debt goes down, it cannot happen because debt going down leads to a financial crisis. Debt can never decrease. Debt can only increase. Otherwise, financial crisis. This is why since the financial crisis, central banks around the world have worked so hard to bring this curve from trending down to bring the curve to trending up again, because it must constantly go up. And if consumers weren't lending, then the government must be borrowing. If the consumer wasn't borrowing, the government must be borrowing, because the debt curve must always be trending up. And lately, it must be trending up at an even faster rate to get any incremental growth in GDP. Because as the world gets more bogged down and more weighted down by more and more debt, it needs more and more debt to get even incremental growth. This is called in economics the law of diminishing returns. Let's see how this has played out. These are some of the major countries around the world. This is their debt to GDP ratio before the crisis. This is their debt to the GDP ratio after the crisis. Not a single country has lowered its debt. But what about Greece? Well, Greece received 300 billion in bailouts. Who benefited from these bailouts? I thought it was supposed to lower the debt burden on Greece, but the debt to GDP ratio has skyrocketed. Well, in fact, the Greek citizens and government did not get bailed out. It's the banks that were holding Greek debt that got bailed out, and the ECB and IMF issuing new loans to support that. So this is what happens. More debt issued to support more of the same. And this is also from the Federal Reserve. It shows the Federal Reserve balance sheet, which is the debt that's held by the Federal Reserve. The Federal Reserve, as I showed you in the previous chart, needs to keep the debt curve increasing. And since companies and individuals weren't borrowing money, they had to borrow money to try to bring that debt curve up again. And this is what happened. What about quantitative easing? We've heard about quantitative easing, which is central banks basically buying up debt instruments to try to stimulate economic growth. Well, what has happened? Let me compare the major quantitative easing programs with what happened in China. The Bank of England roughly did 0.6 trillion or 600 billion in quantitative easing. The Bank of Japan has done 2.1 trillion in quantitative easing. The ECB, or European Central Bank, has done even more. They've done roughly 3.2 trillion in quantitative easing. The US has done the most so far. They've done 3.9 trillion in quantitative easing. But what about China? China has stimulated its banks not through the central bank, but actually through the commercial banks. Because they have a planned economy, they tell the banks how much debt to take out and what the targets are. Well, over the past, or since Q4 2008, this is how much quantitative easing the Chinese government has done through its banking system. The Chinese banking system has increased its debt by 15.4 trillion, more than all the other world's central banks' quantitative easing programs combined. This is why China is facing such a huge problem today. The bottom line is that the global financial system design calls for debt to be constantly increasing and never falling. Otherwise, the system fails. You have a financial crisis. It also means that debt issued can never be repaid, only refinanced into the infinite future. Now let's get into number 4 of the problems that cause a financial crisis. And this is probably one of the most important after debt. Derivatives. What's the definition? Well, according to the New York Institute of Finance, a derivative, simply put, is a contract between two parties whose value is determined by changes in the value of an underlying asset. Those assets could be bonds, equities, commodities, or currencies. The majority of contracts are traded over the counter where details about pricing, risk measurement, and collateral, if any, are not available to the public. So this means that you're trading something that's not an asset, but it could be based on an asset, could be based on a commodity, but it has no underlying asset in itself, and details about pricing or risk are not publicly available as well. It's very opaque. It's the opposite of being transparent. Let's take a look at an example of how a derivative could go bad. In 2012, we remember the London whale. The London whale was a derivative blow-up that happened at JP Morgan. One of the traders there was given an investment portfolio of roughly $60 million to trade in derivatives on behalf of JP Morgan, the bank. Derivative trades started to go bad, and he couldn't cover the trades. It just spiraled out of control. Eventually, total losses from this portfolio reached almost $6 billion. Now, if you're in Islamic finance, you ask yourself, well, how can a $60 million investment lose more than 91 times its original amount? Under Islamic finance, this is impossible. On the conventional side, especially when you're talking about derivatives, this is normal. A $1 investment could end up being a loss of a $100 investment. And this is what happened here. This example just shows you how a small amount, $60 million, could lead to a huge, huge loss. This is just one example. Let's take a look at the size of the overall derivatives market. This information is from the Bank for International Settlements in Switzerland, which is also known as the central bank for central banks. This chart or this graph is in the trillions of dollars, not billions. And as you can see, the growth in derivatives peaked at around $710 trillion in 2013 and started to come down as the oil price started to come down in 2014, primarily because derivatives, a lot of them are linked to energy and other commodities, and as commodities and energy came down, so too did the derivatives are based on. But still today, derivatives are over $550 trillion. That's a big amount, especially when you compare it to world GDP, which is roughly $78 to $80 trillion. How can you might ask yourself, how can the total derivatives be multiple times larger than the global economy? This is simple, because they are bets placed upon other bets. There are derivatives based on other derivatives, which are also known as synthetic derivatives, which are combinations of multiple types of derivatives, which can be insurance contracts, hedges, different types of instruments. The bottom line here to know is that derivatives are extremely complex. And the JP Morgan example, if we go back here, when the regulator stepped in the UK, the regulator could not figure out what happened. They told JP Morgan, please figure this out for us and tell us what happened. It took JP Morgan 11 months to figure this out. JP Morgan, of course, is one of the most savvy derivatives traders and is credited with primarily inventing the derivatives market. So if it took them 11 months to unwind or to figure out what happened to a $60 million portfolio, what do you think is going to happen when you're talking about billions and trillions dollar portfolio? Derivatives, bottom line, are very dangerous instruments that were designed essentially as hedging tools but became gambling instruments. Let me give you another live example to highlight how large derivatives have become. As you can see here, this I pulled up from Deutsche Bank. This is their 2015 annual report. Their annual report came out roughly 2 weeks ago. And if you go to the page number 158, you'll see they have a table here that is called notional amounts of their derivatives. And let's take a look at Deutsche Bank, what they state as their total derivative exposure. The table is a long table, and you can see from here, it goes all the way to the bottom. What I want to highlight here is, first of all, the table is in millions of euro, and this is the total amount of their derivatives exposure. It's small, so let me blow it up for you. According to this table, Deutsche Bank's total derivative exposure is 41.9 trillion euros. Remember, the number is in millions. So this is 41 million, which is 41.9 trillion euros. Well, they must have assets, right? They must have assets to back this up. Let's take a look at their total assets also from their balance sheet. As of December 31st, 2015, their total assets, of course this is in billions now, is 1.6 trillion euro. That's their total assets. Let's compare them side by side. Here's Deutsche Bank's derivative exposure, and here's their total assets. Multiple times larger. And Deutsche Bank, of course, has been having a little issue lately. They've been having some capitalization issues. They've been having some other financial troubles. And I believe it's a result of some smaller issues that are becoming bigger issues in their derivative exposure. Well, you say, if there's a problem with Deutsche Bank, it's too big to fail, it's the largest bank in Europe, the German government can easily bail them out. If they run into trouble, the German government can come and bail them out. Well, let's take a look how this can happen. This is German GDP, roughly 3 trillion. This is according to Eurostat as of 2015. This is Eurozone GDP, roughly 10.4 trillion. And here again is Deutsche Bank derivative exposure. So what I'm saying here is that if Deutsche Bank has a blow up in derivatives, not even the German or the Eurozone economy will be able to help them. And keep in mind, this is one bank in Europe. I'm not even adding in Barclays Bank, Standard Chartered Bank, Commerce Bank, along with all the other banks in Europe that also have equally frightening derivative exposures. Bottom line here, derivatives, they're complex gambling tools and are the leading cause of instability in the financial system, which are now 8 times larger than the world's entire GDP. A small disaster here can easily wipe out most of the world's banks. So these are the 4 problems that were mentioned by the Financial Crisis Inquiry Report. Easy credit, too big to fail banks, too much debt, complex derivatives, they're all bigger today than they were in the past. And this is why we keep having financial crises, and this is why they keep getting bigger. Are there signs of another crisis today? Well, let's take a look at some. First of all, we have falling commodity prices, which is similar to what happened before the 2008 crisis. We have a rising dollar and weakening emerging market currencies, which is similar to what happened before the 1997 Asian financial crisis. We have record debt levels, especially in emerging markets. And we're starting to see highly leveraged funds, hedge funds that is, facing mass redemptions and facing liquidity issues, which is a precursor to collapsing hedge funds, similar to what happened before Bear Stearns. IMF, World Bank, and OECD have all confirmed that there's a slowdown in global GDP. Defaults and bankruptcies are on the rise, and not just in commodity companies. Falling stock markets in the GCC, which have never regained their highs, reached in the last decade. Here are some recent headlines. I just want to highlight a few of them here, but the first one on top is from the Financial Times. It's Maersk. Maersk is the largest container shipping company in the world. Today they're saying that conditions today are worse than the 2008 crisis for the shipping industry. It's terrible news. Lending to emerging market comes to a halt. Remember, lending stops or slows down, you have a crisis. China, February exports tank, down 25%. India exports drop. RBS says sell everything. Chinese consumers are racing to buy dollar. And Reuters says junk bond managers are battling a fallout from Third Avenue, which is a hedge fund, after it blew up. And of course, Dubai property prices are falling. This is Q3 export growth from some of the leading countries in Asia from Deutsche Bank. As you can see, all these leading export countries are down. People are blaming China. They say China in last August devalued its currency. Well, let's compare the devaluation of the Chinese currency, which you can see here in August 2015, compared with the Japanese yen, Canadian dollar, Australian dollar, Malaysian ringgit, Turkish lira, and Brazilian lira. As you can see, all these currencies are down more than the Chinese currency, yet when oil prices started to fall here and the Chinese devalued here, China was blamed. The blame is not on China, the blame is on the global economy itself. Too much debt, too much derivatives, slowdown in trade, and a fall in commodity prices. This is from the Institute of International Finance, which is a bank agency that tracks financial transactions around the world. And they're showing here that money is fleeing China at a record pace. Commodities, of course, this is the Thomson Reuters Commodity Index. Since the fall of oil, are down 44%. This is a broad index in a basket of a broad-based basket of commodities. This is one of the most important charts you'll see, which is the price of oil from February 1991 until, April 1991 until February 2016. And what I want to show here is before 2005, oil was really trading in a narrow band, less than $40. It did not go above $40 until it hit around late 2004, late 2004, early 2005. So I shadowed the area for you. What has happened since then? If you can see here, oil has not traded in a normal pattern since then. Something different or something has changed in the oil market around this time that caused oil to behave this way. If not China GDP growing at 10%, which it has been since before 1990, it's not rapidly rising demand from other countries, which demand has been rising, but to justify this price level, no. So what was the reason? Well, in 2005, this is when oil ETFs began to appear and the launch of oil derivatives or derivative products based on oil products. Once derivatives were launched, you saw how large the industry was. It's in the trillions of dollars in size. This sparked increased speculation and hedge funds entering the market to be able to speculate in the oil market. And this is what caused it to spike up. But then again, oil prices started to fall in 2014, and people said, well, this is because Saudi Arabia is overproducing, you have shale in the U.S. overproducing. That's also not true. Because in 2011, 3 years before oil started to fall, IMF, World Bank, and the International Energy Association, or agency, talked about oversupply in 2011. It took 3 years for the markets to react? I don't think so. Oil, of course, has been bouncing up and down since then, but the real trend is around here. That's probably where oil will settle eventually. Let's take oil a bit further, and I want to compare oil now to the US dollar to see what the relationship is. And if you see here, whenever we have a strong dollar and weak oil prices, the gap that it creates here indicates that there's a debt crisis coming. And in this case, it was the Mexican tequila crisis or bond crisis. Let's see how this plays out in other crises. Between 1996 and 1999, the dollar started to get strong, oil started to get weaker. The gap created the Asian financial crisis and the Russian ruble crisis. I skipped over the 2001 dot-com bubble because the dot-com bubble was not a debt crisis. The dot-com bubble was an equity crisis. There was very little debt involved. So when we get to 2008, we see that oil started to rise, then it started to fall. As soon as it started to fall, oil started to get stronger, and dollar got stronger, oil got weaker. The gap here indicated that there's a debt crisis, and of course, we had the global financial crisis. Let's take it out today and see what happened. Today, the gap is the largest I have ever seen. The dollar has not been strong in many, many years. Oil has not been this weak in a long time as well. What about GCC stock markets? As you can see here, GCC stock markets, you may not be aware, peaked a long time ago. Saudi Arabia peaked 10 years ago. Dubai, over 10 years ago. Kuwait, and mid-2008. They have never recovered since then. They attempted a recovery before oil prices started to fall, but now the trend is down. Bottom line, the signs of another crisis are everywhere. If you don't prepare now, it will be too late to save your wealth. Will central banks be able to save us again? Well, let's remind ourselves. Bernanke didn't think subprime would be a problem, and he didn't think the U.S. was in recession when they're already in recession. What did central banks do to try to rescue us? First of all, they tried to stimulate trade and economic growth, reduce the cost of debt and the debt burden, discourage savings and encourage spending, and of course, they had set inflation targets, roughly 2%. Global GDP and trade is down. Inflation is well below their target. None of them are reaching their inflation targets. We're entering a period of deflation, which central banks promise will not happen. And we have a new phenomenon today called negative interest rates. Negative interest rates have already hit Europe and Japan, and they will be spreading soon to other countries. This is a bizarre phenomenon that we have not seen ever in our history. Velocity of money, for those of you who are not familiar with velocity of money, it measures how quickly money turns around in an economy. And this is like the three bears. It cannot be too hot, it cannot be too cold, it must be just right. So since 1959, when the U.S. began taking statistics of this, here's how the velocity of money has gone up and gone down, and then you can see the velocity of money today is the lowest it's ever been, meaning money is not circulating, meaning that the economy is getting strangled. It's not circulating as it should be. What about the federal funds rate? Same thing, not too hot, not too cold. It goes up and down with the economic cycle. And lately it flatlined. There's a slight dip to the upside, but in essence, this is something we haven't seen before. To show you how this has never happened before, this is a chart from Deutsche Bank, and they're comparing bond yields of the US, UK, Switzerland, and Japan through their entire history, not 10, 20 years. This goes back to the 1700s in some cases to show you that interest rates have never been this low ever in history. What we're experiencing today has not happened ever. So central banks to the rescue. Buy even more debt, keep interest rates low, punish the depositors and savers. The results, equity markets hit new highs and are turning over now. Bonds are going further into negative territory, GDP is falling, and we're getting deflation, which is also leading to the gap between rich and poor is accelerating. So how would I rate central banks? Well, simply they failed. This is a report from the Federal Reserve itself. They did a report on quantitative easing and its effectiveness. Anybody can pull this up. There's a link here. It's from July 2015. As you can see, they say there is no link that establishes that QE achieves the ultimate goals of the Fed, which is inflation and economic activity. Bottom line is QE has been ineffective at increasing inflation, and countries that have used quantitative easing longer than the US, such as Switzerland and Japan, are actually seeing the opposite effect. So in theory, QE should stimulate growth, but in reality, as Japan and Switzerland have proved, and now the US, QE has an opposite effect. It leads to lower inflation and even deflation. This is from the Federal Reserve itself. So the bottom line, central banks now admit they have failed, but nobody is talking about it. Trust in central bank is fading. By the time it completely fades, so too will your wealth. Deflation and its negative effects on your wealth. I'll go through this quickly because there's a lot of information to cover here, but I just want to highlight the importance of deflation. First of all, deflation is the dirtiest word in economics. Nobody wants to talk about it. The general definition, it means a decline in prices. Right? You buy a laptop today, you go back tomorrow, that same laptop has gone down by 20%. We're familiar with this. This is good inflation. Bad inflation is debt deflation, which is what we're experiencing. The theory says that the theory of economic cycles, which holds that recessions and depressions are due to the overall level of debt shrinking or deflating, meaning that the credit cycle, which is increasing debt, decreasing debt, is the cause of the economic cycle. And remember this chart, more debt means more economic growth. Reduced debt means reduced economic growth. This is debt deflation, and this is what we're entering into today. And of course, a famous economist, Irving Fisher, who studied the Great Depression, he came up with these stages of deflation, which we're seeing now, which is debt default, liquidity, distressed selling, which is a self-fulfilling prophecy or a circle that feeds into itself. What I want to pay attention to here is on number 3. When you get to this debt deflation cycle, the thing or the asset that performs best or the thing that outperforms everything else is dollar. Cash outperforms everything else. All assets go down as people try to liquidate to raise cash to pay off debt. And this is what we're seeing today. So we will not hear from the experts on debt deflation today. First of all, it's proven by the Fed. Massive QE has not led to inflation, but instead is promoting deflation. Fact, global trade and industrial production is slowing fast. Fact, the US dollar is rising and nearing record high primarily due to deflation, not for the reasons you hear from institutional advisors or the media, such as increasing trade, increasing flow of dollar. Primarily reason why the dollar is increasing in value is because everything else around it is falling in value, and there's debt deflation. Countries, individuals, institutions need to raise money to pay debt. A lot of the debt is in dollar rises. Fact, demand for dollars is rising fast, especially in China. Wall Street Journal did a report here which says Chinese consumers are racing to buy dollars. And the central bank in China is telling banks that they're having dollar shortages. This is physical cash dollar shortages. In fact, debt defaults are accelerating in nearly all markets. Bottom line, debt deflation is here today regardless of whether experts admit it or not. Deflation is the biggest threat to your wealth. Bail-in and bail-out. Well, we all know what a bail-out is, right? A bail-out is when somebody steps in and bails you out. And in the case of the last crisis, like Greece, Portugal, Iceland, taxpayers were the bail-out. The new trend, however, is bail-in. Well, what is a bail-in? A bail-in is when the borrower's creditors, in a bank's case, for example, the bank's creditors are its lenders, its equity holders, and its depositors. So the bail-in theory now says that when a bank runs into trouble, the bank must look at its creditors first before it asks for a bailout from government or taxpayers. And this has already happened, as we remember, in Cyprus. Cyprus took a bail-in, meaning its bondholders, its equity holders were wiped out, and its depositors took a haircut on the deposits they had. Well, how can this happen? Well, it's already happening. According to the IIF, Cyprus' approach of hitting depositors and creditors when banks fail will likely become a model. This is 2013. It already is a model today. According to Forbes magazine said the Cyprus bank bail-in is another crony bankster scam. 1 year before Cyprus bail-in, the IMF wrote a paper on how to do a proper bail-in, which was a blueprint for Cyprus. It has since been implemented in other markets. This is from December 2014. This is the Bail-in Powers Implementation Law by the UK government. Not only has it reached the UK, EU regulators told 11 other EU countries that if they don't pass bail-in laws last year, that they will be fined. So every major EU country now has bail-in laws, meaning that if you're an account holder in a European country, the bank has a problem, your deposits are at risk. Countries that have high bail-in risk include the entire EU, and this is the UK as well, the US and Japan. Canada will be added to the list as well, and countries with low risk are Switzerland, Singapore, Hong Kong, and Australia so far. This may change. GCC countries are so far safe from bail-in thanks to government's preference to do a bailout. There's no political will to do a bail-in. And this, of course, is from the UK manual. This tells you how they take your money. They start with Tier 1 equity, they go to additional Tier 1, then Tier 2, subordinated debt instruments, all the way down to secured and unsecured liabilities, which include you as a depositor. Wall Street Journal did a story because S&P cut the rating on these banks listed here because the bail-in legislation there. So they said that the likelihood of extraordinary government support is uncertain thanks to new regulation. This regulation is new bail-in legislation. This just shows you that governments and central banks around the world do not have the appetite or political will because of the voters' backlash to do bailouts. This is why they're forcing a bail-in first before they consider a bailout. As you saw from the derivatives blow-up, a bank with a derivatives problem could easily wipe out the entire bank and its creditors and then take the government if they choose to even consider a bailout at that point. Governments and central banks are prepared for the next banking crisis. They will force banks to take your money in a bail-in first before they bail out any financial institution. All right, let's try to wrap this up now, and then we'll go through some questions. I just have a few more slides here. The financial system runs on a boom and bust cycle. Financial crises occur more frequently and are becoming more severe. Governments and central banks have failed to fix the problems. The core of the problem is an exponential growth in debt combined with an out-of-control derivatives market multiple times larger than the entire world's GDP. The mega banks cannot be trusted and are core to the problem. The rating agencies' recommendations can be taken with a grain of salt. Bail-in rules will force your money to be used during the next crisis. Deflation is a reality and is accelerating, which is a phenomenon central banks promise will never happen, which will lead to large cases of default, both corporate and sovereign, along with falling asset prices across the board. What are the solutions? Well, these are some high-level idealistic solutions. If you're in Islamic finance, you already know what the answers are. However, the sad truth is that take a crisis to fix the problems, but you can expect a new system to bring back ethics and moral standards into the financial system, which are principles of equality, shared risk, and elimination of moral hazard. Return to stock principles. This could be a new gold standard or other constraint. It doesn't have to be, but the point is there must be a constraint against government being able to issue as much money as it needs. Remove the casino from the financial system. By this I'm talking about derivative. Find solutions to a debt-based financial system, such as equity. Here are some strategic recommendations, or what I call financial rules of thumb. I put a top 10 list here, but you can add more. In this deflationary environment that we're facing, nothing will outperform cash. All assets will lose value as cash becomes, well, king. Your deposits in international banks are not safe due to new bail-in laws, so move your deposits to banks that do not have these laws. The majority of assets will lose value, but some assets will fare better than others. Real estate may not be a bad asset, it might come down, but stocks are a terrible asset to hold at this stage. So real estate, better than equity. Be concerned about the return of your money, not the return on your money. You're concerned about safety and capital preservation at this stage. Sell more stocks and bonds. Deflation punishes debtors, so get out of debt. Many banks, companies, and countries will go bankrupt. Expect governments and central banks to restrict the movement of your money through capital controls, and we're seeing this already. International payment systems, by this I mean wiring money around the world to whichever account you want, and electronic exchanges that we're all familiar with today could fail and ultimately collapse. The winners in the end will be those who have the buying power once markets bought 1 to 3 years to be able to acquire most assets at historic bargains. Well, you might think some of the stuff that I just said is crazy, but let's take a look at what some of the experts are saying. This is from CNBC. Cash is the best place to be. Standard Chartered is $10. This might be a stretch, but this just shows you that where they see the commodity going. And of course, this is from March this year, not too long ago. HSBC says cash is king. RBS, which is the Royal Bank of Scotland, says sell everything as deflationary crisis nears. And that's all I have for today, so I'll be glad to open it up to any questions you may have. Are there any questions? If there are, I'll wait till they come through and I'll try to address them as they come in. All right, we'll wait another minute or so and then we will address some questions and then I have a question here that says, would you say the media is playing its part as a media watchdog badly? I would say of course, because if you look at the primarily financial media such as the Bloomberg and the CNBC, they have a vested interest in making sure markets are constantly rising, everything is good, markets are always improving. Just go back to the last crisis, for example, and how many years were they talking about a recovery, a recovery, a recovery? 7 years into a recovery and they're still talking about a recovery. Lately they've changed the tune a bit, but when in your lifetime have you heard of a financial crisis taking so long to recover from? And the media probably played a great part in trying to promote stability, trying to assure calm, but I would say they performed badly in trying to tell people what was really happening in the market. Question came in, what kinds of derivatives are the most saleable in this world? Well, the most common derivatives are Forex derivatives, which are based on foreign currencies. The next category are interest rate derivatives. And I would say commodity derivatives, which are primarily energy-based. That's probably third down the line. But the two most common forms of derivatives are interest-based and currency-based. Another question came in, do you think this is the best time for financial institutions to realize the importance of asset-backed or asset-based lending? I would say that this is obvious by now, and this is why you see a lot of interest, especially if you look at the Sukuk market. The Sukuk market has taken off, and if you see who are the main buyers of Sukuk, they are conventional financial institutions, pension funds, and insurance companies, because they like it and that it's a different type of asset class. All right, it says here, please elaborate that why you are comparing notional value of derivatives. The actual liability is a fraction of the notional value. The notional value of derivative simply means that if this were to be paid out, this is the total amount that will be paid out. What the bank actually pays for the derivative, or the value of it, is the premium it pays. It's similar to a stock option. The stock might be worth $10, but the option on it is 50 cents. So the notional value will be the $10. The actual value would be the value of this derivative. I combine the actual value because that's the value you're going to want to receive when it comes time to pay up. An example of this would be holders of Greek bonds. They want to buy insurance to protect against the Greek bond they hold. If I hold $1 billion in Greek debt, I pay $2 million to buy an insurance contract against this $1 billion. When the Greek bond defaults, I go to the lender, or I go to the person that, or the institution that issued this, and I say, pay me my $1 billion, or pay me the difference between what I actually sold it for and the $1 billion. So that becomes, the notional value becomes important when an event occurs, a default event, or a payout event for the derivative. And the derivative gets more complex as more stages are built into it. I mentioned that there's something called a synthetic derivative, which means a derivative based on the outcome of a basket of derivatives. And the complexity of it means one on top of the other, and you can slice it and dice it and take one portion of this basket of derivatives and put it into another basket and sell that one off. So because it's an opaque market, trying to figure out who owns what derivative and what portion of it is so complex. And if you remember the JP Morgan example I gave you, it took JP Morgan 11 months to figure out what went wrong. So I think it's very important to show the notional value of derivatives, because you want to know what happens if there's an event. And the whole purpose of buying a derivative, you think, would be that you want to have a payout event. Okay, another couple of questions came in. How will the Islamic financial system be a better financial solution since it's still running under the current global system? This is true. The Islamic financial system is not an independent or standalone financial system. It depends on the conventional financial system. The book I wrote talks about this in detail, and what I mentioned is that yes, the Islamic finance represents roughly 1% of the global financial system, and I'm adding all the crazy derivatives and all the debt out there to it, but it's only 1% of the global financial system. What I'm hoping that the outcome would be is that when another crisis occurs, regulators and bankers and economists and other people in the market, they will be trying to find or look for solutions, and I hope that they will consider Islamic financial solutions to some of these conventional problems. And one of them would be what to do with all this debt. Now, there are already conventional market experts proposing solutions that are by its nature Islamic or Sharia compliant. One of them is the famous author of The Black Swan, Nassim Taleb. He wrote a book that talks about instability of the financial system, but he offers a solution, and a lot of people listen to him. One of the solutions that he provides is, well, you have all this bad debt. If somebody can't pay their debt, convert it into equity. Well, this is an Islamic financial solution. So this is how I propose Islamic finance contribute to solving global financial problems. Not that Islamic finance is a standalone system, it's not ready for that yet, but Islamic financial principles can be used to apply to try to find solutions. Another question is, let's see here. It says here, need to look at interest from at least 3 aspects: micro, macro effects, and fairness dimension. I'm not sure what the question is here, but yes, of course, you must take into consideration the big picture and also the fairness. A lot of people would say that debt is not fair by its nature, especially when you see how debt is issued. I mean, how does debt come into existence? It comes into existence by a bank saying, here it is. A bank lending you $1,000, for example, where did the bank get it? It did not get it from its depositors, because the depositor still has claim to this $1,000. So where did this $1,000 come from? The bank just invented it in its system based on you as a depositor having your money there. So by the fact that they created this this money out of depositors' money, and they gave it to, or they lent it to a borrower, the bank has a right to this money now, the depositor has a right to his money, and the person who borrowed the money has an obligation to pay it back. So if you dig into the big picture and you study the gap between, what we say, the increasing gap between the wealthy and the poor, one of the aspects that is mentioned a lot is the debt as a fairness issue and how it's unfair. This is one aspect of it. Are you optimistic that the next crisis will lead to effective reforms, having already experienced stalemate of Frank Dodd? Well, as I showed you in the beginning of the presentation, that financial crises are becoming bigger and more severe. I think the next crisis that we're entering will be more severe than the last one. I think it'll be an extreme scenario, and therefore there will be no choice but to find solutions to it. I think they were able to table it at this time because of the massive stimulus that they put into the system, which at this point they'll need multiple times larger than that stimulus, and I don't think there's a political will, or and I also think there'll be a political backlash if they try to attempt to do what they did last time. I also think that because the derivative market is multiple times larger than it was in the past, they will be forced to find a solution. What is the best derivative for Islamic finance? Well, there are multiple types of Islamic finance derivatives. None of them are approved, I would say, universally. We have, tawarruq, we have arbun, we have things like this. We have profit rate swap. We have foreign currency swap rates, things like that. None of them are widely used, and they're still in their infancy in how they're developed. So I think the better question to ask is how best to hedge, because the whole point of a derivative is to hedge or to buy insurance. Well, let's find better ways to do this instead of creating a gambling tool. I mean, there are better ways to hedge than create gambling instruments. Why regulators don't regulate derivatives market for hedging purposes only, or limit the outstanding derivatives? This is precisely what the recommendations were for post-financial crisis. However, because of the control of the banks by the politicians in the US and in Europe, and because the derivative market is so big, they were not able to. They were too afraid to touch this, so they couldn't. The size of the market has gotten so big, and as I showed you from the JP Morgan example, a small incident in the derivative market could cause such huge financial catastrophe So therefore, the efforts to regulate it, both by the bankers and by the politicians, were put aside. And of course, to all of our detriment. Let's see here. Your proposed solutions, bringing back ethics, gold back, seems to work at a macro level. What are possible solutions to a level? Well, I gave the gold back as an example. I don't really think a gold back will be so effective today. We'll have to come up with a different solution maybe. But bringing back ethics, I mean, that's a universal value. We can all bring back ethics. We don't have Muslims to bring back ethics, but we can all agree that ethics left the financial system many, many years ago, and bringing back ethics and moral standards will do a lot to improve the financial system. So what are the solutions at the micro level? I think at the micro level, especially when we're talking about stimulating local economies, we're looking more at micro-lending, microfinance, equity financing. We don't have to go to a debt-based system, and I think that's the issue when we look at it. We're all looking at this from a debt-based scenario, and we need to think of things in terms of more equity-based. If I'm looking at sharing risk, I must share in the profit as well as I must share in the loss. And I think that's a more just system that we need to look at. We can start to overcome the crisis by issuing more sukuk. They don't have any debt. So for them to issue more sukuk, it's for a way for them to, fill temporary budget gaps. But if you're looking at global economy, I think sukuk can benefit because sukuk require an asset to be in existence, whereas a bond, you don't need an asset, you just need a promise to pay back, and you rely on the creditworthiness of the lender. So I think sukuk being asset-backed, asset-based, offers a solution in that you cannot have outstanding debt or outstanding IOUs multiple times more than the entire GDP of the world or the entire assets of the world. Some more questions. Do you think, okay, wait a second, I think I answered this one on sukuk. What do you think about the current Islamic derivatives term and reliability? Well, I think derivatives, like I said, is in its infancy in the Islamic financial market, and when we're developing new products in Islamic finance, we have to go back and see what is the reason, what's the purpose. Are we creating Islamic derivatives because the global banks would like to see this, and they would like to, make quick profits and bet? Or are we creating this as a true hedging instrument? And I don't think that has really been addressed yet. We need to really see why we need to create derivatives. And do we not have any other alternative? What is the title of your book to address the dependence of Islamic banks to conventional banks? No, the title of my book, and I can go back and show it to you. Hold on. This is the title of the book. Question is, do Islamic banks, or can they contribute in lending booms that contribute to the financial crisis, especially in the banking crisis? Well, Islamic banks typically do not lend, they typically finance, and they finance projects based on assets. So I think that's a key differentiator there. The trend of Islamic banking and financial institutions are also taking debt-based financing in its majority of their products. Do you think that this has also imposed a similar problem as conventional one? Minus the effect of derivatives because they are not employing one. I think a lot of Islamic financial institutions, yes, a lot of the instruments and financing tools that they've done in order to mimic or mirror the effects of a conventional financing lending transaction. And I think this has been one of the problems. But the bigger issue for Islamic banks, although they don't have any direct exposure to derivatives, they do have a lot of money being held by these big banks who are exposed to derivatives. And Islamic banks have high amounts of balances with international banks because they use it to do their tawarruk, their marat, their other treasury type activities. So if a bank has a big treasury department, you need to see who's placing this treasury money for them and where it's placed. If it's placed with one of these banks with high derivative exposure, then that bank is also exposed. It says here the question is, the Wall Street Journal predicted a crisis in March 2014, but nothing happened. Please comment. Well, there are always people predicting crisis. If you were asked to ask me today, we are in a crisis. Look at where oil prices have gone. Look at how far emerging market currencies have fallen. Look at the rest of the commodity plays, how they have fallen. Look at the stress on emerging markets to pay back debt. Look at the stress on companies that have taken out so much debt to pay back this debt. An example would be the U.S. oil and shale companies. They're under tremendous stress because they cannot pay back all the debt they took out because they're giving such lofty projections of where oil prices will be and where the production will be. So there's a lot of stress in the system today, similar to what happened in 2007. You weren't personally feeling it yet, but the crisis was there. And I believe that the crisis is here today. You look no further than the stresses that the governments in the region are facing, emerging markets are facing, fall in commodity, the problems in China. China is in a crisis. And central banks. If we weren't in a crisis mode, why are central banks continuing to come up with new types of QE, new types of stimulus? In the world alone, there are roughly $6 trillion in bonds that are yielding a negative interest rate today. What is the purpose of negative interest rates? Negative interest rates are supposed to stimulate you to spend your money and not save it. That's not working. So the crisis is here. You're not feeling it in your personal pocket yet, but you will soon. What are your recommendations for the emerging market? What should they do? Well, I think the biggest problem emerging markets have is that they have a lot of debt that's not denominated in their own currencies. So, for example, if they took out, if they borrowed $1, they need to sell whatever assets they have to get dollars to pay back the dollar holders. And this is why you'll continue to see the U.S. dollar get stronger and stronger, because emerging markets, companies in these markets, oil companies, they all need to pay their debts back in dollars. So my recommendation, of course, is, well, number one, pay off your debt. But then again, if they want to issue more debt, obviously they should look at sukuk as a viable way to do it and issue in their own currency. Question is, ideally, if we could have an Islamic financial system in place globally, would there still be a boom and bust cycle? There probably would be, but they won't be so severe. It'll be more of how it used to be, I would say maybe 100 or so years ago. You'll have boom and bust cycle, but because debt could no, I mean, I'm talking globally, so I'm assuming that there's still debt. I'm not saying that we're talking only Islamic finance. There would be a boom and bust cycle, but it won't be so severe because debt would not be able to rise multiple times larger than the assets that are available out there. Question come up again. Could you please explain again the exposure of Islamic banks to large conventional banks exposed to derivatives? Yeah, Islamic banks, of course, do not have direct exposure to derivatives. They do not have the exposure, they cannot buy derivatives, they stay away from it. However, Islamic banks have large treasury departments. Treasury departments place deposits among central banks, of course, but among other things, they place deposits with international banks to do commodity marabaha for them, to do tawarraq, to do other types of money market type instruments. So while that money is not in the central bank or in the Islamic bank itself, that money is being held by foreign banks that typically trade large amounts of commodities, so the leading commodity trading banks. These banks, of course, by their definition, they all have large exposures to derivatives. So if one of these banks were to have a problem in derivatives, the Islamic bank may not be able to access its money that it placed with them, or it could even disappear depending on how severe the situation is. I hope that explains it. The question is, what is the link between financial stability and the sovereign debt by governments? What is the implication for the real economy? Well, sovereign debt by government, it depends on what the sovereign government is issuing it for. And the GCC, for example, the sovereign governments are looking to issue debt to simply cover their budget gaps. And what is their budget? Their budget is primarily social welfare programs, salaries, and local infrastructure projects. That's what they spend it on. But what about other countries in Europe, for example? What is their debt spent on? And if you look at the sovereign governments in Europe, a large portion of it, and in Japan I think it's up to 1/3 right now, 1/3 of the debt is simply being issued to pay off existing debt plus interest. That's another reason why there's negative interest rate, to make this less of a burden on governments. But if governments are simply issuing more debt to pay back existing debt, this is where the cycle I talked about, in that debt can never be repaid. It just has to continually be refinanced into infinity. So this is what happens. You pay off a $1 billion, you issue 1.2. You pay off 1.2, you issue 1.4. You issue 1.4, you pay back 1.6, and it has to keep rising into infinity until you hit a wall, which we might hit a wall someday. I'll answer one last question here, and then we can wrap it up. It says, considering considering every bank note we hold in hand, someone is paying interest on it somewhere. How can cash be king in the next crisis? This is a good question, because as I mentioned before, every dollar in existence exists because a loan was issued on the back of it. The dollar is a debt-based or debt-backed currency. The simple answer is most of the debts in the world are issued in dollar. I mean, there are a lot of debt issued in euro and other currencies, but say, for example, let's just look at debt issued in dollar. You owe debts in dollar, and you're a corporate. And your revenues are shrinking, and lenders are calling you back, pay off your debt, you owe us money. Or this could be an oil company. You said you're going to have this much revenue by now. You're not achieving your revenue targets because oil prices are down. You still have to pay back our debt. How do you pay back our debt? You don't have any more cash, but you have assets. You start selling whatever assets you have. You have some gold, you sell your gold. You have some real estate, you sell your real estate. You have some rights to drilling wells, you sell those rights, all to raise cash in order to pay back the debt. When you pay back the debt is considered to be retired. Debt being retired means currency supply and the economy is disappearing. That is debt deflation. So when you're looking to sell everything to raise dollar to pay back debt so debt disappears, that by definition is debt deflation, and that's why the dollar gets stronger and stronger, because more and more dollars are in demand. And debt, and that's why I say cash is king, particularly the dollar. All right, with that, I would like to wrap this up and thank everybody for the good questions they had. And I hope everybody had or enjoyed the presentation. And if there are any more questions, maybe the staff at ERTI can field them, and I'll find a way to answer them, inshallah. But thank you very much, everybody, and have a good day.